Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Sofi's SOFI stock and why their CEO as well as other directors are buying up more of the company's stock, which is fantastic news. Then we're going to move on and talk about how PLTR is going to continuously trend down according to this particular author, and I will be refuting some of the things that he brings up. Then lastly, we're going to talk about Tesla's TSLA stock and why it has been removed from the S&P 500 ESG index, which is not preferably good news. However, I do want to say and clear up some misinformation that this does not mean that Tesla stock has been removed from the Standard & Poor's S&P 500. It means that it's been removed from ETFs that track the S&P 500 ESG index. So those are clearly different indices, and some people just didn't know that. We're also going to talk about how electric vehicles are increasing in vehicle registration, which means that people are adopting and using more electric vehicles, on top of how Tesla is going to surpass GM and Ford by revenue in 2025, or even if that is actually possible. Lastly, I want to say that Webull is having a fantastic investment opportunity right now if you don't have a Webull account. So, Webull is a brokerage account and they're celebrating their 4th anniversary, where people who invest $100 into any stock can win up to $12,600, and at minimum, they're going to receive 6 free stocks. So, in my personal opinion, I would make a Webull account, I would invest $100 into VOO. If you don't invest $100, then you're not going to be entered in to win that $12,600, and you also will not receive those 6 free stocks. So if you want more information about the Webull brokerage, go into the description box down below and there will be a link for Webull's 4th anniversary, so I can give you all some free money and some free stocks. Worst case scenario, you can just liquidate the stocks that they give you and pull out your $100 30 days after you invested, and bada bing bada boom, you've made some money. Anyway, let's jump right into this video, and we're going to start off talking about the SOFI stock, which currently trades for around $7.20, with the low-end analyst 12-month price prediction coming in at $7 and the high-end bullish price target coming in at $22 per share. What's really exciting for the SOFI stock is that the CEO has actually purchased more SOFI shares along with another director, which is fantastic news. It's always good to see insiders buying up the stock of the company that they are directing and or are the CEO of, and particularly the CEO has bought a load of stock where his total stockpile is close to 3.2 million shares of the SOFI stock. If you didn't know, SoFi Technologies is a fintech company, which is a financial technology company, and they offer an all-in-one inclusive app that gives their customers anything they could possibly need, basically, in terms of financial services and or financial products. And despite the SOFI stock dropping by around 50% in their value year to date, and this is the reason why insiders are actually buying more of the company's stock, and this is despite their very impressive Q1 earnings results, which I did an analysis video on, and they also beat analysts' estimates for their revenues and a few other things, and this is why insiders are actually buying up more stock. So, the CEO of SoFi bought around 39,000 shares of the SOFI stock at an average price close to $6.50. So he's already massively up on his $250,000 investment to where now he has 3,199,339 shares. On the exact same day, a director of SoFi Technologies bought around 15,000 shares for the same average price of around $6.50, to where now that director owns around 229,852 shares. And this is not the first time we've seen the CEO and director buy the SOFI stock. They've actually been buying this stock very consistently ever since the stock dropped below $9. For instance, the SoFi CEO bought around 34,000 shares at an average price of around $8.91, and then he bought another 19,042 shares when the stock price dropped to around $7.84. He also made a few other purchases where he bought 62,927 shares. So in total, he acquired around 154,969 shares of SoFi stock below $10. So clearly this signifies that at minimum, the SOFI stock price should be trading at least around $10, and anything below that, to me, and according to the CEO and other insiders such as directors, think that this company is a fantastic buying opportunity under that price point of $10. This clearly shows that the SOFI stock price is not only trading at a good discount right now for a buying opportunity, but it also signifies that this is also a good company to hold for the long term. Also, investors were actually surprised that the company has increased their full year guidance for 2022 by increasing their overall revenue projections as well as their EPS forecasts. So clearly SoFi stock is a stock that you want to keep your eye on, or at a minimum a watch list. But with that being said, we don't want to overexpose ourselves to a single risky stock. There are plenty of other stocks that are trading at a phenomenal discount right now, and there's no sense in overexposing ourselves to just one single company. But with that in mind, let's talk about the latest Palantir developments, and the PLTR stock currently trades for around $8 per share. If you didn't know, Palantir Technologies is a big data and analytics company that serves both commercial clients as well as government enterprises. Their low-end analyst price target is around $6 for the year of 2022, while their high-end bullish price prediction is around $25.30. However, according to this article, despite the PLTR stock dropping by around 54% year to date, he thinks that the PLTR stock is still considered overvalued. He says, according to this article, one of his bullet points, and I quote, "For Palantir to achieve a similar valuation to Microsoft, it must double its cash flow and quadruple its revenue, only to justify its current stock price of around $8.30. Now, what I want to add right here is that comparing these two companies are not apples to apples. This is apples to oranges, and I'll explain why. Microsoft clearly is a blue chip company that has had multiple years to grow and actually find its current valuation, while on the other hand, people are buying Palantir, not what it's based off of its worth today or the revenues or even free cash flow that it's bringing in today, but rather the free cash flows and revenues that it's projected to bring in the future. So clearly, comparing Microsoft to Palantir is an apples to oranges comparison and not an apples to apples comparison, which means that this comparison shouldn't even have been drawn. Also, he says that the market is overestimating Palantir's competitive edge and their overall moat, and he says that they overestimate their overall growth projections, which we will talk about later in this video. He goes on to say that their government segment is being hit extremely hard and that they didn't bring in good Q1 results, and I will talk more about that right now, because kicking Palantir for their drop in government revenue makes very little sense, because this was clearly offset by their commercial revenue, which I predicted would happen over a year ago, and I still stand by my prediction that eventually their commercial clients and their commercial revenue will outpace their government segment, and that's going to be the thing that leads them to profitability in 2025. However, the author of this article doesn't think so, and he says to buy the PLTR stock price above $10 is clearly an inflated price prediction. So let's actually dive into this article, and as always, the sources and resources that I use are always listed and linked in the description. So we're going to start off talking about their revenue potential, because that's why people are buying this company. They're buying the current stock price based off of the future revenue projections and the future cash flows, not their present cash flows. What also got investors excited is that they have been told multiple times that Foundry, which is their commercial platform for Palantir, is what Amazon Web Services was 10 years ago. And this was mentioned 2 times in 2 various earnings reports, so this has invigorated investors, because everyone wants to be compared to Amazon in some fashion, just like how Sofi is supposedly the Amazon of fintech, which I actually agree with in some regards. However, again, it's not a one-to-one comparison. He goes on to say that if there is a 15% chance that the Foundry platform will become profitable or even as successful as the AWS system from Amazon, that the PLTR stock should be trading at around $15.75 per share. But he says that this valuation downplays the competition that Palantir is facing from other software vendors, and Palantir likes to give off the image that their product is so unique that it warrants their own category. However, he rightfully points out that they do face competition because in 2020, the DOJ, which is the Department of Justice, actually replaced Palantir's technology with other technology from DataWalk, which is a Polish microcap company. And this means that there is other software out there that can replace Palantir's technology, even though they can't do exactly and as securely as what Palantir can do. So I actually agree with him on that point. He also says, according to their Q1 report, which I did an analysis video on previously, that they are delivering lower than expected growth expectations. But I completely disagree, because they brought in around 31% growth, which, yes, has been one of their lowest growth quarters since they went public. However, clearly this is still above management's projections of a 30% CAGR or compounding annual growth rate from now until 2025. And clearly anyone can tell you that 31% is greater than 30%, so clearly they are meeting growth expectations despite what this author wants you to believe. And for some reason, he says that the recent sell-off is actually completely justified, which I disagree with, because this would be contradicting what he said earlier about buying the company under $10 could be a good opportunity, or that at least we shouldn't buy above $10, which the inverse clearly applies. Buying below $10 is a good price to buy the company at. He also rightfully points out that their US commercial segment has experienced growth of around 136%, which is absolutely massive, and I actually predicted that this would happen multiple times in past videos, because their revenue grew from around $35 million for their US commercial segment to around $84 million, and clearly this means that they are rapidly scaling their commercial side. He rightfully again points out that year-to-date the PLTR stock dropped by around 60%, and although it makes Palantir a more attractive company to buy, they still are trading at 60 times their operating cash flow, and their enterprise value to sales is around 11.2 times, which is almost 4 times the IT sector's average. And again, he rightfully points those out, which is why he says anything beyond $10 for the PLTR stock, if your average price is above that, then you could be in deep trouble, which again, the inverse would mean that buying below $10 or having your average cost below $10 is actually a reasonable place to put the PLTR stock. He says you could be better off buying the S&P 500 ETF SPY, and although I do agree with him because I think that investors need to have a strong foundation of ETFs and blue chip stocks that tracks some indices such as the S&P 500, but for me personally, like I said earlier, I don't really like SPY. I would rather invest into VOO, and both of these actually track the S&P 500. I just think VOO is better than SPY, which is why if you are going to invest $100 into VOO and you haven't signed up for Webull yet, go sign up for Webull with the link below, invest $100 in VOO, get those 6 free stocks, and then liquidate your positions later. Or honestly, Webull is a good brokerage that I personally use, and I will just continue to use it because this is literally free money that they're giving you. But again, you can actually invest into any investment with your $100 investment. I would just rather buy VOO, and I would dollar cost average into an index such as the S&P 500, which is what I'm actually doing right now as the stock market is falling. I am investing into VOO every single week by hundreds and hundreds of dollars because it just makes it a fantastic buying opportunity. But I regress because now I want to talk about Tesla, which is an electric vehicle manufacturer, and they also do a lot of other things. Currently, the TSLA stock trades for around $709, while their high-end analyst price target for the year of 2022 goes as high as $1,620. Now, the reason why Tesla is in the news today is because they have been cut from the S&P 500 ESG index, which again is not the Standard & Poor's S&P 500 indice. However, nonetheless, Elon Musk is furious about this because according to this article, which quotes Reuters, it says, "An S&P Dow Jones Indices executive told Reuters on Wednesday it has removed electric car maker Tesla Inc. from the widely followed S&P 500 ESG index because of issues including claims of racial discrimination and crashes linked to its autopilot vehicles." And Tesla's CEO Elon Musk responded with harsh tweets, including that, quote-unquote, ESG is a scam. And we will get right into that tweet right now, because Elon Musk tweeted that Exxon is rated top 10 best in the world for environment, social, and government's ESG by S&P 500, while Tesla didn't make the list. ESG is a scam. It has been weaponized by phony social justice warriors, end quote. So he's basically saying that if Exxon is considered the top 10 best in the world for the environment, and they're a fossil fuel company, and companies like Tesla are being removed because they aren't doing enough for the environment, this is absolutely preposterous. And honestly, I agree with Elon Musk here, and so do other activist groups, because apparently the activist research group named As You Sow, they actually rated the Spider S&P 500 ESG ETF as a D rating in terms of being a climate activist, which means that they take the environment into consideration. Because the reason for this very low rating is because fossil fuel stocks make up 6.5% of the fund's assets. So clearly, there's a clear contradiction, especially if they're taking out companies like Tesla and yet praising companies like Exxon. So clearly, there is politics involved here. Nonetheless, we see electric vehicle adoptions increase because registrations of electric vehicles in Q1 of 2022 have absolutely skyrocketed, which is very bullish for companies like Tesla and other EV manufacturers. New registrations for electric vehicles have actually increased by around 60% from just a year ago. This means that the total EV market takes up around 4.6% of the overall automotive market right now, which is absolutely fantastic. This gives EV companies, especially Tesla, more runway and growth to catch up to other legacy vehicle makers that are still using gas-powered vehicles, which we will talk about in our next story. So this is clearly going to increase sales for Tesla and other EV manufacturers. Clearly, Tesla is the number one in electric vehicle car sales, which is absolutely fantastic, which is why Tesla makes up the majority of this EV market, because they have around 70% of the total EV market under their belt, which is absolutely a huge monopoly in my opinion. However, Tesla can radically increase their numbers if they release cheaper vehicles to compete with GM, because Chevrolet, their Chevrolet Bolt electric vehicle, which starts at around $31,500 with a 259-mile range, is going to start production again, and it's going to be on dealers' lots soon. So, by making EVs more affordable, GM is going to increase their overall revenues. So how is Tesla going to fare against this? Well, surprisingly, a lot of people don't know that Ford and GM make a lot more revenue than Tesla in terms of their vehicles. This is no surprise because GM and Ford dominate the automotive industry, while Tesla's sales revenue numbers for the first quarter of this year was around $16.9 billion according to this article, which is a far cry from General Motors' $36 billion and Ford's $34.5 billion for the exact same period according to Motley Fool. However, do not be dismayed because Tesla is rapidly increasing their revenues much quicker than General Motors or Ford. So to put this into perspective, for Q1, General Motors increased their revenues by around 11% year over year, while Ford actually experienced a drop in revenues of around 11%, which compared to Tesla is absolutely fodder because Tesla has increased their revenues by around 87% year over year. So clearly it's just a matter of time before Tesla passes these legacy automakers in terms of vehicle revenues. Some people think this is going to happen as soon as 2025. However, the author of this article disagrees with that. However, the CEO, who is Elon Musk, actually says this could happen as soon as 2024, especially with their new gigafactories over in Germany and the United States. This is not only going to ramp up production, but it's going to give Tesla supply so they can meet the demand and sell more vehicles, which in turn will increase their overall revenues. This is not rocket science. This is very simple and straightforward, and I believe if Tesla doesn't pass the revenue of GM and Ford by 2025 or 2024, it's literally only going to be a matter of time because they are scaling their revenues much quicker than these legacy automakers. And again, to put that into perspective, the CEO, who is Elon Musk, actually projects that Tesla is going to scale their revenues from now until 2024 at a rate of 50% on a compounding annual growth rate basis, which is absolutely insane. Anything above 30% is impressive, 40% is crazy, and 50% is absolutely insane, which actually covers the three stocks and companies that we talked about. Palantir Technologies is increasing their revenues by a 30% CAGR from now until 2025. Sofi Technologies is increasing their overall revenues at a compounding annual growth rate of 40%, and Tesla is doing it at a 50%, which is why all of these companies are very good long-term stocks in my personal opinion. But I would love to hear your thoughts down below. Remember to go and smash that like button for more videos like this one, subscribe if you are new, and I will see you in the next YT video.